Thank you all for dialing in. We have a large number of people who have registered, and we will allow a moment for people to join. Due to the high volume of guests, we will not be taking questions from the audience and would ask that you please direct all questions after the call to your CBA Relationship Manager. I will now hand over to Anthony Kritikides, Managing Director of Institutional Sales at CBA. Please go ahead.
Hello, and thank you, and good morning to everybody for the July 2025 RBA update call. I'm joined today by Belinda Allen, CBA's Senior Economist, and Joe Capurso, who's Head of International FX in the Economics Department. Okay, Belinda, we'll start with you. I had my script all prepared, but I had to change it rapidly at 2:31 yesterday after a shock decision by the RBA. Can you tell us what happened and what you saw in the statement and the press conference afterwards?
Thanks, Anthony. Luckily, I didn't preempt and write the note yesterday, given the RBA did surprise us and leave the cash rate on hold at 3.85%. So going into this meeting, markets were pretty much fully priced for a rate cut. The incoming flow of data and no pushback from the RBA on the general consensus of economists and financial markets all led us to think that July was likely for a rate cut. We didn't think it was a definite, and we thought reasons around the RBA wanting to wait for the quarterly CPI, a less heightened global situation, and a still tight labour market could be used for reasons for the RBA to not go, and that's the RBA we got yesterday. So by the RBA leaving the cash rate on hold, they certainly pivoted back to a cautious stance than we had expected, certainly after that dovish tilt in May. And it certainly seems that they want to wait and see the full quarterly CPI print that we get out at the end of this month to ensure and confirm inflation's heading back to the centre of the target band before continuing on with the easing cycle. So the Governor, Michelle Bullock, was at pains to point out in a press conference that the discussion by the board was just about timing of the next rate cut and not about the direction of the cash rate. So an August rate cut appears almost certain, barring a large miss to CPI for the June quarter. What's also really interesting from yesterday is we got the first look at how the board members voted. They're unattributable, so we don't know who voted for on hold versus a rate cut, but it was a split decision. So we had 6 board members vote for on hold and 3 board members vote for a cut. So definitely a split decision by the board, definitely unexpected from the Reserve Bank compared to what us economists and financial markets thought. But reading the Governor yesterday, more rate cuts are expected based on how we and they think the economy is going to be tracking. They just want more data before continuing on with that easing cycle. So we certainly learned a lot yesterday. We learned a lot around their communication. We learned a lot around it being kind of a new independent Reserve Bank board, but certainly was a big surprise at 2:30 yesterday.
So on that, Belinda, so yourself and most economists in the end said thought there was going to be 25. Certainly the messaging, as you said, last meeting suggested they were going to go 25. The market was pricing actually more than 25. So if you believe that the market is a sum of all knowledge, the market has decided, right, they've got enough information, we're going to cut. And we all got it wrong, basically. What do you think we actually missed? Given the data since the dovish tilt, the data hasn't really been that great anyway. So what have we got wrong between and the result in such a shock decision?
It's just the timing. So they are still, at the end of the day, they're an inflation-fighting central bank. And one of the points that really stood out to us in the press conference yesterday is the Governor said they don't want to have to fight inflation again. So while in May they talked around inflation risks being broadly balanced, we thought that meant inflation was in the rear vision mirror. They were more worried about the activity side of the Australian economy. I think we got that a little bit skewed. They're still focused on inflation. We've gotten 2 monthly CPI prints since that May board meeting, and there were some mixed results in that. And certainly in the press conference, the governor went into a little bit more detail about why they want to see the full quarterly CPI. They just don't trust that monthly CPI yet. Not all prices are measured each month. There were some prints, particularly around durable goods and new dwelling construction costs, that came in a little bit higher than what we and the RBA thought. So it's just that them wanting to see the data to confirm. So I think we got that part wrong. The focus on inflation we got wrong. And I think we need to go back to that May board meeting where a lot of us took a dovish read out of that because they talked about cutting interest rates by 50 basis points, and we put too much weight on that. And certainly that's what the governor was saying in the press conference yesterday is, yeah, we talked about 50, but we dismissed it pretty quick. Whereas I think we, the economists and financial markets, maybe put too much weight on them talking about 50. And then the other big difference, I think, as well, is back in May, the global situation was more heightened. Their forecasting round back then maybe put too much weight on the global situation deteriorating more than maybe what it has, although I know Joe's going to touch on that very, very shortly. So I think it's a combination of those few things. And I think, and I'm sure we'll touch on this very shortly, is we all thought they would push back on that market pricing, and they didn't. That's what they've done in the past, and we haven't heard from the Reserve Bank since May. So we all took that as them endorsing effectively cutting rates in July, and that's where we were wrong.
Yeah, I certainly think from the market's got to learn a lot about this. As you say, it's a new board, a new looking board, independent. Michelle's new, relative, not that new governor, but she's clearly started showing, how she sort of views this. And I think the market's just got to think, whereas other central banks maybe more observe what the market's pricing. Well, this RBA clearly obviously knows how the market's pricing. It's not going to get pushed and swayed by the market if that's not what they're thinking. So we certainly learned that yesterday. Just on the economic data, obviously CBA sees a lot go through our bank accounts, and the HSI print we produce, things like that. We've seen employment was sluggish, but still 4.1%. Demand retail sluggish, but okay. Inflation, as I say, still been a relative problem, but in the band. Credit markets have been solid. We're back to the lows of before the whole April sort of flare up. So overall, you can sort of make a case for why they didn't go. If you look back on it, but how do you read the economy just generally as the economist for CBA? How do you see the state of the economy?
Yeah, so we definitely think the economy is recovering. It's just slow. So particularly on the consumer side, generally at this part of a recovery in household income, you would expect the consumer to be stronger. It's been choppy this year. We've gotten some signs of green shoots coming out of our internally generated data, but it's not yet assured. And I think what this delay in the rate cutting cycle now could do is further put a headwind on top of the consumer, given I think everyone was expecting that rate cut yesterday. So the economy is growing a bit above 1% at the moment. We're expecting it to grow to a bit above 2% by the end of this year. We expect the public demand side to put a floor under growth, but maybe not lift growth as much as what we've seen in recent years. But as I said, that recovery is not assured, and the pricing signals we're getting out of the economy through inflation and wages to us mean interest rates don't need to be as restrictive as what they are now. And I do think the RBA agrees. It's just we were wrong on the timing. They want to be cautious. They want to be predictable. It looks like they're going to stick to that quarterly cadence of moving after that quarterly CPI print. And I think our views on the economy are generally very similar. It's just about how fast you want to deliver that easing cycle into the economy. So it now looks like they're going to go slower than what we would have thought. That does raise the risk of the slower you go, the more you may need to cut rates because you may delay that recovery, particularly in the consumer. So we're expecting the RBA to cut in August and November. you cannot rule out a third rate cut after that, particularly, as I've said, if this delay puts another headwind on the consumer, who already looks like they've suffered some scarring post the high cost of living environment from 2022 to 2024, still a clear preference to save and pay down debt. Yes, we're seeing some green shoots around spending, but it's not yet assured. So that's our general view on the economy. We think rate cuts are necessary and manageable for the Australian economy by the data and how we're reading the data. And really between us and the RBA, it's just, as I said, a debate about timing now.
So with the, and I'm been nervous talking about market pricing now, considering what happened, but markets now got pretty much cut price for August, another cut in November, and terminal rate around 75 basis points. So a total of 3 cuts by basically Q1 next year. So what is CBA's official view now on that timing and also terminal?
Yeah, so we've got a rate cut in August and November and risk of a third. So just unpacking August a little bit more. So certainly from yesterday, we learned that for the RBA, they want to see that quarterly CPI print. At the moment, their implied forecasts are for trimmed mean inflation to print at 0.6% for the quarter or 2.6% through the year. The risk based on the monthly CPI data that we've gotten to date suggests it could come in a little bit stronger than that, around a 0.7% and slightly higher on the year, around 2.8%. If it's just that small upside surprise, and I think that's what the RBA is expecting when they talked about it's broadly in line with their forecast, they'll cut rates in August. If you see a bigger upside surprise from that, then August is in doubt, although it will depend on how other economic data flows, I think particularly around the labour market. And of course, in August, they need to go through another forecasting round. So looking at how all the activity indicators are printing, how the consumer's going, and of course, how the global situation's evolving as well. So we are expecting that rate cut in August. We are also confident that inflation will continue to be within the target band. So we're expecting that other rate cut in November and the risk of a third. So that would bring the cash rate back down to 3.1% is certainly a risk. And I think just depends on how the economy evolves. And if we do see inflation is on the downside of the 2 to 3% target band. So that's what we're watching. But our base case is for August and November at this point, and that would take the cash rate down to 3.35%.
Just before I move to talk to the international piece, just final question on the domestic situation. So we've got over 500 clients registered for this call, and a lot of them are from the retail sector and that's one area of the economy that seems to be struggling. Would have benefited from lower rates, I would have thought. So how are you seeing that? You talked about the recovery earlier being slower, but how about the patchiness of the recovery? Are we seeing that coming through our data?
Yeah, it is definitely patchy. So we're seeing it patchy across categories. We're seeing it patchy across home ownership status, across age, and across area as well. So generally what we've seen over the course of the last year or so is the younger age groups hold back spending more, or older age groups lift spending to a faster extent. We've seen those with higher incomes perform better. We've seen those who own their home outright perform better. And we've seen a real mixed performance by category. Some preference for spending on one-off events, big ticket items, discounting, promotional activity has also drawn the consumer in. In more recent months, we have started to see a shift. So we have started to see that lower interest rate cycle improve spending by renters and those who have a mortgage. That's what you would expect. So we need to see how we go as we progress further through the rate cutting cycle. So it is definitely a very divergent consumer. What we have also seen is still a clear preference to save and pay down debt. So money flowing into CBA offset and redraw facilities continue to track higher than what we've seen in recent years. And we also know that only around 10% of eligible customers lowered their mortgage repayment after the May rate cut as well. So that was a similar amount at the same point as the February rate cut, but it's still pretty low. So that tells us something about the consumer psyche. And if we look at what models suggest the consumer should be doing, they're still underperforming in terms of how much they're lifting their spending by, given the improvements we've seen in disposable income.
So that would suggest that people are banking the money and paying down some debt and shoring up their financial position rather than going and spending it.
Yes, that's right.
Yeah, interesting. That's great. Thanks, Belinda. I'll keep you on because I'm sure you can't talk about the international economy without the impact it has on Australia, so I'll keep you on. But, Joe, can we just quickly pivot to market's reaction yesterday? Aussie jumped pretty significantly on the announcement. Everyone was expecting a cut, as we know. It jumped. It hasn't managed to hold on to those gains, but it's still relatively elevated at up around 65.5. What are your views on the reaction to the Aussie and the Aussie more generally?
So, look, the Aussie did put on about 50 points very quickly, but didn't hang on to those gains in the overnight session, and that's because there's still many problems in the global economy. The global economy is going to go through some soft patches before the year is out, and that, of course, just comes down to the US tariff policy. So the US has applied quite high tariffs on a range of countries. We found out earlier this week that about 12 or 13 countries will soon have a tariff rate that averages about 31% if they don't agree to a trade deal with the United States by the end of the month. So time is ticking, and those sorts of issues tend to push the Aussie dollar down. So we saw on Monday the Aussie dollar lost 1% just because of comments by President Trump about what he might do on tariffs for countries that align with the BRICS organisation. So I think over the next few months we should expect that Aussie will endure some regular sharp dips. Aussie's a volatile currency anyway, so it can easily fall by a few cents over a very short period of time just based on comments by the President or by unexpected changes in tariff policy.
And it seems like overnight there were some more headlines on tariffs. It feels like this deadline isn't going to be pushed back this time. What do you think, Joe?
Yeah, look, there is a new deadline now. We can confirm that given the President's executive order has been published. So the new deadline is the 1st of August. The President wants all economies except China, which is on a different track, to have a trade deal with the US by the end of the month. And without a trade deal, the President has said that he will increase tariffs back to somewhere near those reciprocal tariff rates that he announced in early April. Now, financial markets have responded only modestly negatively to the new deadline. Now, for me, a source of possible financial market turbulence is the tariff rate on imports from the European Union. If the tariff rate on imports from the EU is judged by the EU to be too high, the EU will retaliate. And the US President has said that if any country retaliates, he's going to retaliate immediately by the same amount. But the EU made it crystal clear over the last few months that they are ready to retaliate to the US. They know what products and what tariff rates they will apply to imports from the US. Now, the reason the EU is so important here is because if you cast your mind back to early April, it was the bout of retaliation between China and the US that was largely behind the market volatility in early April. So the market really does not like two big economies going head-to-head with tariff retaliation. And that's the risk this time round, is that it's the EU rather than China. So we do need to be really attuned to the US tariff on imports from the EU, because we could be back to April all over again.
Yeah, I think Joe, you're right there in that people so rightly focus on China, but people often forget how big the EU is and how big an exporting nation, region the EU is. So that's a really interesting point on that. On the Aussie, clearly tariff wars, etc., hurts the Aussie, and we saw it had under 60 cents back in April, as you say. But equally, ever since the April news. The de-dollarization theme is one that's, it's continued on this. People are thinking that the world is sort of moving away from US dollars somewhat. It's still the world's reserve currency. There's absolutely no doubt about that. It's still the most traded currency in the world and at the base for most commodity markets. But we have seen the US dollar weaken significantly against the euro and other major currencies, including the Aussie. And Aussie's probably underperformed that, but Aussie has rallied on the de-dollarization theme. So is the Aussie going to get caught between trade wars and this move out of the US dollar? Or do you think the de-dollarization's a bit overdone, this whole theme?
Yeah, the de-dollarization theme, or the sell American narrative, as it's more commonly called nowadays, that really got going in March of this year. And there were several influences that have pushed the US dollar down, but it really got moving in March after the market re-rated upwards European growth prospects because of looser fiscal policy in Germany and the EU wanting to build up their defence spending. So that really kicked things off. But then in April, the erratic US policy making around Liberation Day, that I think Anthony has undermined the safe haven bid of the US dollar, something that is fairly new. And added on to that, of course, was market expectations of lower US interest rates. Now, I think these European growth prospects are probably overdone, and expectations of 4 Fed rate cuts, I think, is overdone. I think both of those things are going to fade away. But you can also add a fourth factor, which the Bank of International Settlements has written a bit about recently, and that is that they believe there was a large increase in dollar hedging by big corporates and funds, and that contributed to a lot of dollar selling a few months ago. But that momentum of that increase in hedging is probably faded now, that those companies that wanted to do their hedging have already done that. So the upshot here is that the US dollar will probably regain some of its recent losses in the next few months. Once the tariff war fades, and hopefully that's sooner rather than later, but I think by the end of the year, the tariff war will fade. Central banks will resume their interest rate cuts, and that kind of environment of a better global economy is usually a weight on the US dollar. So the upshot here is the US dollar probably recovers in the near term, but as we get towards the end of the year and into 2026, the US dollar is likely to start to fall against most currencies, and that will help support the Aussie dollar.
And if the Aussie stays up here, that should be, and potentially even go a little bit higher as things settle down. Maybe that is potentially good for inflation as well, which the RBA be conscious of. I would have thought at 59 cents, it's more a concern than when it's at 65 and it stays here. Just one final comment for you, Joe, before we head back to Belinda for final thoughts. But the big beautiful bill got passed. Clearly, the Congress over there isn't too concerned about the state of the US debt and the amount of debt that needs to be rolled over and things like that. And the talk about bond vigilantes is back out there again. So what do you think this act, as well as the tariffs you talked about, what does this mean for the US economy and more broadly the global economy?
So the big beautiful bill is about cuts to social program spending and cuts to taxes on personal and corporate income. Now, these cuts in isolation will definitely increase the budget deficit by more than $3 trillion over the next decade. Now, the US budget year starts on the 1st of October, so a few months from now. Now, those cuts will overall have a positive impact on demand and spending starting next year. But the tariffs are going to provide a significant offset. We estimate a global effective tariff rate of between 11% and 12% will pay for these tax cuts. In May, which is the latest data we've got, the US global effective tariff rate was 9%. So it's pretty close to that 11 to 12% that we'll pay for the tax cuts. Now, as I said earlier, the President earlier this week said that he will apply high tariff rates on more than a dozen economies that average 31%. Now, we expect those tariff rates are going to be negotiated down. But a US effective tariff rate of somewhere between 15% and 20%, I think is very likely. So in other words, tariffs can pay for the tax cuts. But of course, tariffs are going to weigh on demand and they will boost inflation. And that implies that the Federal Reserve is likely to be slow to resume cuts to the funds rate, a bit like the RBA, but for different reasons.
Yeah, it'll be interesting to see. Obviously, President has been very vocal about his dislike of the way Powell's running the Fed, so it'll be interesting to see if he can hold his reserve like Michelle held her reserve yesterday. Belinda, one final comment from you. We've heard about your view about the RBA and the economy, international impacts. You've talked about 2 more cuts, August and November, risk of a third, but where's the risk to this whole view? Is there a risk that they have to go faster at some point because the economy slows, or is there a risk that they actually don't go because they're worried more about inflation? Where do you think the risk lies if you look at it like this?
Yeah, so I think the risk is more cuts than less cuts. So just based on, I guess, the disjointed recovery we're seeing in the consumer and what that means for inflation. So on our forecast, we have inflation hitting around the midpoint of the target band, if not a little bit below, throughout our forecast horizon. And that's with a pretty reasonable consumer recovery. So if we don't see that come through because of a slower rate cutting cycle, then the risk sits with more. And that's why we do have 2 rate cuts in our profile, clear risk of a third. And I think, as I said, that's very much dependent on the behavioural response from the consumer from here. And of course, I guess the bigger unknown is the uncertainty tax on Australia from everything that's happening offshore. So what it means for business investment plans, we have seen them shifted a little bit lower as a result of what's been going offshore. So that's, I think, the bigger uncertainty. And yes, we have factored some of this into our forecast, and we do think it's disinflationary for the Australian economy, but clearly the risks, both from a local perspective and an offshore perspective, sit to the downside at this point in time. And that's despite still a really good labour market. So we haven't seen that pick up in the unemployment rate. And I think that conversation then turns that this is where the labour market should be. An unemployment rate of around 4% is something the Australian economy can cope with. It's just then what it means for the inflation side. And we're a little bit more relaxed on the inflation side than maybe where the Reserve Bank is at this point in time.
Yeah, great. Well, thank you, Belinda, and thank you, Joe, for your thoughts. For clients listening, you heard a lot here, and a lot of opportunities for rates to come down, potentially stay where they are. FX is going to be volatile, so a lot of opportunities and to hedge over the coming months. So speak to your dealers about that. And Belinda and Joe, thanks again for your contribution and for all our clients dialing in. And look forward to our next RBA call, which we'll come back with the exact date, but will be after the next RBA meeting, which is on August 12th, so in a day or two after that. So thank you all for your attendance, and good luck.